Hi there, I'm Matt Heimer. I am the features editor at Fortune, and I'm the editor of our annual Investor's Guide. And this is the Fortune 2018 Investor Roundtable. Every year we bring together 5 panelists with different areas of expertise to get together and have a conversation about the markets and what we expect from the coming year. And having just finished a year that was very tumultuous politically and very good in the markets, we have a lot to talk about. So I want to start by introducing our panelists today. We have David Giroux, who is the Chief Investment Officer for Equity and Multi-Asset at Rowe Price. Kira Van Vallen is the Managing Director and Portfolio Manager at Epoch Investment Partners. Dan Chung is the CEO and Chief Investment Officer at Alger Management. Savita Subramanian is the Head of U.S. Equity and Quantitative Strategy for Bank of America Merrill Lynch Global Research. And Byron Dieter is a partner at Bessemer Venture Partners. Thank you all for being here. It's really, really great to have you. I want to start with a broader question. I'd like to start by talking about the very long bull run that we've had in stocks at this point. The bull market's almost 9 years old. Some Cassandras, myself included, have been worried that markets have been overvalued and that stock prices have been too high, especially in the United States over the last couple of years. Is a slowdown or even a market correction looking more likely in 2018? Savita, I wanted to start with your take on that.
Sure, yeah, it does feel sort of unsettling that I think by next July, we will be in the officially, if the market continues to go up, we'll be in the officially the longest bull market, you know, by technical definitions in history.
Yes.
And that doesn't feel too great. It doesn't feel good to buy equities now. But I guess, you know, if you think about 1999, it was a year where valuations were getting high. You know, one sector was driving most of the returns of the S&P 500. It didn't feel great to buy equities. Yet that was one of the best years of that bull market. So I guess the risk to me is that if it's not over, you don't want to miss it at this point. And you know, when I look at trends in earnings, when I look at valuations, when I look at kind of sentiment measures for the S&P 500, it's not like we've hit these levels of euphoria where investors are all in, there's no other game in town, and stocks look like they're going to go up forever. You're not hearing that rhetoric, really. You're really hearing more about what could go wrong rather than what could go right. So I would argue that sentiment is shifting from skepticism to optimism. At some point, it'll peak out at euphoria, but we might not be there yet. And then on valuations, you know, the market looks a lot more expensive on a variety of valuation metrics, but it turns out that valuations are a really lousy market timing model if you're concerned about what happens over the next 12 months. The amount of returns that are explained by the PE ratio are basically close to zero. And that's what makes me think, yeah, it doesn't feel good to buy. Stocks look expensive, but the last year or two of a bull market are actually where you get the strongest returns.
You invoked 1999 earlier. One of the better performing areas of the market in the past year has been technology.
Yeah.
But Dan, you were saying to me earlier today that by a lot of measures, actually the valuations of tech stocks relative to history is not that high. Can you explain a little bit what you mean by that?
That's correct. So if you look at the 20-year median PEs of each sector, even with the run that they've had right now, actually technology and also healthcare are basically trading at their median PEs. The sectors that are trading actually at premiums are actually materials, utilities, staples, and industrials, where they're at somewhere between 14% to even close to 20% premiums to those mediums. So by that measure, technology and healthcare actually remain reasonably valued.
And Byron, you had been mentioning to me that within the tech world, there's tech as a sector has essentially become so large that you are really talking about an umbrella that covers many different parts of the economy. And you were saying that in some of those areas, the opportunities still look both reasonably priced and really kind of poised for a lot of growth. Can you tell me a little bit more about that?
Yes, absolutely. So as good as the bull run has been around tech, where it's outperformed the other indices roughly 2x, we passed some major milestones last year that I think show it's due to fundamental business performance. One of those milestones that was a great event, July of this year, the 5 largest market cap companies on the planet were all venture-backed tech companies. You know, going down the list with Apple, Alphabet, Microsoft, Amazon, and Facebook. Number 6, by the way, is Alibaba, also venture-backed, but yes, Chinese. And so they have passed the Berkshires and the JP Morgans and the Exxons for the world's most valuable companies. because of fundamental business performance. And as you think about the trends ahead, mobility, machine learning, cloud computing, a lot of these tailwind trends that are ripping through large portions of the economy are increasing and going to continue.
One thing about some of those stocks that you mentioned to me, I'm thinking particularly about Apple. When I started out as an investment reporter, the idea of most tech companies ever paying a dividend was almost unheard of. But now, of course, Apple does, and Microsoft does, and others may follow. And dividends, I think people often think of those as a defensive play. Kira, you specialize in investing in yielding stocks and dividend stocks. How does that affect your thinking right now? And if the mood in the market is a little nervous, does that make your arena look more attractive?
So I think we are still quite constructive on performance for next year. If you think about the fact we've moved from a market that's been fueled by quantitative easing, and now I feel you have seen in recent quarters that it's more the actual fundamentals, the earnings growth, the cash flow growth that has driven the markets, and we think that can continue going forward. So we're not looking for a large market correction. However, a more defensive strategy where dividends are always positive contributors to equity market returns certainly would be well positioned in that environment. So we're not looking for a correction by any means, but should one happen, focusing on companies that are profitable today, that can consistently deliver growth year after year and consistently return the cash to shareholders would be a smart place to be invested.
Are there any particular sectors or any particular companies that are really leaping out at you for that kind of longevity of opportunity?
Sure. We have found in recent years more opportunities within the tech sector, smaller, I will say, than some of the other opportunities that we have. But you have seen more of a commitment, to your point, about companies returning cash to shareholders. Even companies like Texas Instruments, 100% of the free cash flow is returned via dividends and share buybacks. So there certainly have been more opportunities within tech, although it's still limited if you have a dividend focus and dividend objective. We tend to steer away from really making a call on sectors or on countries per se. We just want to find individual companies that continue to grow year after year and have consistent capital allocation policies that reward shareholders in a very consistent and predictable fashion.
And David, you're sort of taking the opposite, like 35,000-foot view, where you're looking at a lot of assets under your sort of purview. Do valuations in any of those particular categories worry you right now, or are you advising clients to kind of pivot out of one and into another?
Sure. I would say, just generally speaking, globally, wherever you look, valuations are high. In fixed income, credit spreads are kind of tight. Even, the risk-free rate, the treasury rates are kind of low as well versus history. So there's no real good value. You are correct. Sort of foreign stocks are nominally cheaper than U.S. stocks, but when you look under the surface and you think about the different sector exposures, as well as sort of the lack of sort of the FANG stocks in other markets, what you tend to find is that European stocks and U.S. stocks are somewhat similarly valued on a relative basis.
So you're saying take out the FANGs, which is, if you're not familiar with that term, that's Facebook, Amazon, and Netflix, the big tech, Google, and the big tech players. I guess it's FANA now with Alphabet. But so you take out those companies with their huge market capitalization and their huge valuations, and some of that price imbalance goes away.
Yes. And I think I would say the one sector that we like a lot today right now is sort of healthcare, and I would really say sort of non-pharma healthcare. So if you look at that sector, you're basically getting companies trading at a market multiple with probably 1.5 to 2 times the growth rate of the market. And again, relative to the defensive sectors, because I think Savita's right, we're sort of probably later in the cycle. I don't know if we're going to have a correction 18, but we're sort of later in the cycle today. I think it makes sense to be a little bit defensive in that, given that time where we are in the cycle. And I think, relative to staples where valuations are kind of high, and also you have sort of more secular risks or utilities, which are very, very expensive, I think healthcare is a really good place to be from defensively positioned with good earnings growth, less secular risk.
Are demographics driving that? Is that in part a play on just an aging population that needs to consume more healthcare?
It would be demographics, also emerging markets. So you think about some like the life science tool companies. They play into, they have a lot of exposure into China. And you think, well, what's driving China's growth rate? What is sort of the secular drivers of China? It's like healthcare, food safety, water quality. These are things that all those life sciences companies sell into, and they're growing from more bioproduction. They're growing from more emerging market growth as well.
So life science tools companies, what's an example?
Say like a PerkinElmer per se, or a Thermo Fisher.
I see. I think of those tools as being sort of an overlap of healthcare, and again, we talked about technology kind of covering everything. This is in some ways a tech play too. And Dan, you were saying that Alger is in a lot of ways following tech developments that are in the healthcare space, and where do you see some of the things playing out?
Right. So we do see a lot of opportunity in healthcare. The demographics are great. The emerging markets opportunity is also strong. And we like the med tech area, the equipment area, and we also play in the pharma and biotech area. I think in pharma and biotech, for example, you've got, I don't know how many years ago the human genome was sequenced, and then the development of ever faster, ever cheaper sequencing techniques. But that set the base for research that is now coming out with new drugs. Immuno-oncology is one of the big hot areas in cancer drugs. So these are drugs that understand sort of the immunomarkers on our cells and try to target the drug therapies more specifically to cancers are not all the same, basically, the differences among cancers. Cystic fibrosis, company Vertex has shown pretty remarkable advances there in treating that terrible disease. The point being, though, in a larger sense, a lot of scientific advances that happened 10, 15 years ago are now actually emerging from the healthcare industry as advances in drugs and therapies. It is coupled with, though, for example, on the equipment side, know those companies well that David mentioned, but we like, for example, Illumina, which is one of the genetic sequencing companies that provides the heavy horsepower to analyze specific genetic codes and sequences for clinical and research purposes. I would note there's also advances that are software and automation-driven robotic surgery. So a great company like Intuitive Surgical is showing improved surgical results by using more and more automation software and also, of course, vision techniques to allow surgery to be done in that fashion. And so we see a lot of innovation in the healthcare sector, and some of it is sort of the, I guess it's the flowering of the early scientific results that were achieved, and also combined with internet and cloud computing techniques.
Is that these kind of healthcare innovations and technological innovations, Savita, is that still kind of a section of the market that drives the U.S. economy more than some of its rivals? I mean,
oh, sure. I mean, I think that's one reason the U.S. has outperformed the rest of the world over the last 8 years is that, or maybe it's been longer, is that tech is, the biggest percentage of the benchmark in the U.S. Biotech basically really only exists in the U.S. I mean, it's hard to find a meaningful biotech stock outside of the U.S. So I think that one of the reasons that the U.S. equity market has been on such a tear is that it represents what's been scarce over, the last, close to the longest bull market we've seen, which is growth. And I mean, it's kind of interesting that we've had this bull market amidst a very disappointing economic backdrop. Every year we think this is the year where the economy really recovers and heals, and then it doesn't. I mean, maybe this is the first year where we've actually seen really strong indicators of economic growth. The Fed is officially done. But I think that, that the U.S. represents probably more of that secular kind of non-cyclical growth than other areas of the world.
Let's talk for a second about tax reform, which right now is a big question mark, but it's obviously top of the headlines. We've been talking about American companies selling worldwide, and as we know, they're parking a lot of their earnings there because it gets unfavorable tax treatment when it comes home. If tax reform passes and the reform that's currently being discussed, a lot of that cash comes back to the states. If that happens, for you, Kira, as a dividend investor, does that mean a lot more cash flows back to shareholders because the company's just bringing that much more home?
We do think that there could be a potential for additional share buybacks. It's hard to say exactly how it's going to impact dividends because you do need some consistency. You need some longevity to these tax cuts for there to actually be a reason to potentially change your capital allocation policies because you pay dividends out of reoccurring sources of cash. You want that organic growth to continue to support that going forward. It's unlikely that any one-time cash change is going to, or any tax reform per se is going to increase capital investments because access to funds has been quite easy in recent years, so a one-time event shouldn't change that. So we would expect it potentially to materialize more through share buybacks If there's a permanent level to the tax reform and tax reductions, then you might see that dividends could increase even without companies having to change their capital allocation policies because they would be more profitable going forward. So it does open up a potential, but it depends really how the tax reform ends up happening, and there has to be something permanent.
Sure. A lot of one of the arguments in favor of tax reform is an idea that it will make that it will incentivize investment and R&D. Byron, you're really working in a world that's driven by fresh investment and fresh R&D. Do you feel like the companies that you're seeing at their early stages would benefit from that kind of change in the tax code?
So I think there's a few macro policies that could impact the innovation economy and really startups in particular within tech. One is certainly tax policy, the other is immigration policy. And I think there are some real positive potentials from tax policy. I do think that some of the things under discussion around the treatment of options and vesting periods could actually have a detrimental effect. And then on the immigration side, the objective fact is that 51% of companies in the tech sector at over $1 billion in market cap were started by at least one immigrant founder. If you throttle that back, or if you start to limit immigration, there will be disastrous impact on the innovation economy.
That's absolutely right. Tech is most exposed to H-1B visas out of any other sector. So, yeah, that is a big risk for the tech story.
If that risk comes to fruition, who gains if we lose?
So, I mean, if we're moving from a global, like we've had this great globalization story for the last 20 years, and if we're shifting down or we're shrinking that story, I guess the rule of thumb is you'd want to go domestic. You'd want to go for U.S. companies that hire primarily U.S. workers, which I think is ultimately inflationary and potentially stagflationary because we're crimping off growth from overseas. But in the short term, you'd want to buy more domestic, less global companies, and tech is basically the poster child for globalization.
Sure, sure.
Although I would argue that as an international investor, I think China would be in a very strong position for investors to find opportunities. Their internet industry is just as strong as the U.S. They're making huge investments in the Silk Road Initiative infrastructure, which are having a strong impact. And if the U.S. is really withdrawing from globalization and immigration, they're a source of capital as well for all of these projects, as well as talent. So, you know, an important opportunity emerging there. And they've come through a slower period of economic growth. It's not slow by global standards, but by their standards,
Yeah.
But I actually think China is on the recovery. I just returned from there last week, and it's amazing how the changes there occur every 2 years, it seems. It's still just a little
very,
bit
very
more.
fast.
And I would point out companies like Tencent, where in mobile payments, they're well ahead of Western or even European standards.
Sure. David, what's your take on the way the stakes in the tax reform debate?
I think, actually I spent a lot of time in DC over the last year. I think you will see tax reform. The question is it going to be sort of the aggressive form of tax reform where you really see a 20% corporate rate, or is it going to be a little bit more, more sort of a plan B, if you will, sort of maybe a 23, 24% corporate rate, maybe a little bit less impact on the deficit. And I think it's unclear which way it's going to go. But I think it's a positive for the U.S. market because the average company today in the market has about a 27% tax rate. You know, if that can go down to 20%, that could boost earnings for the market, you know, 7, 8, 9% per se. I would say some of the sectors in particular that would benefit from that are more the domestic companies. Sort of, you know, financials, consumer discretionary would probably be the winners. And I would also say I think the market is probably partially pricing some of this in, but at the same time, there's a lot of high tax rate companies today that would have their earnings go up 15 to 20% that are really not pricing in that optionality very, very well. So I think there's a little bit of inefficiency with that optionality today.
What are some examples of that where it's not priced in as much?
So if you look at a company like a Fiserv that has a 34% tax rate, you know, their earnings could potentially go up as much as $1 if you had tax reform. And their relative valuation today is not out of line versus history, if you will. You can look at a Dr. Pepper with a 34% tax rate where their earnings, where they're actually trading at a discount to where they've historically traded, where their earnings can go up 15%, Comcast. There's a lot of high tax rate companies that are just not being appropriately valued for this optionality.
Let's talk a little bit about small caps versus large caps. Speaking of tax reform, I mean, historically, it's been argued that a big tax cut benefits smaller companies more if it's a domestic tax cut. Savita, are you seeing a change in the way those are valued? Or large caps have been outperforming small caps for a while, but might that change if tax reform passed?
It's interesting. Yeah, I mean, I think since we started hearing more rumblings of tax reform actually happening sometime in the near future, small caps have dramatically outperformed large caps. And it's true, small caps pay a higher effective tax rate. They would stand to gain a lot more from that tax cut. But I think within small caps, you need to be careful because the question is, how much of that tax benefit are companies going to actually retain? And what we found is that when you have a windfall for a sector or for the market overall from a lower corporate tax rate, a lot of that benefit is actually competed away through natural forces. So for example, if you're in a commoditized industry and you and all of your competitors get, a windfall in terms of a lower tax rate, maybe you pass that on to your consumers, to your customers through lower prices, and that marginal benefit actually gets whittled away by natural competitive forces. So I don't know if it's as clear-cut as small caps are going to win in this tax reform scenario. It all depends, I think, on pricing power and competitive threats within the industries.
Byron, you were telling me that in the IPO world right now, because private capital is so easy to access, there's a little bit less of an incentive for companies to go through an IPO. Does anything you see coming in the next year, including tax reform, but also beyond that, change that scenario? Could 2018 be a bigger IPO year?
Quite possibly. A lot of people talk about 2017 as coming back a bit from IPOs, but I think that's a relative statement to how disastrous 2016 was. And so when you look ahead, we have this very bizarre market dynamic happening right now, which you can call the logjam of the unicorns, which is 8 years ago was the first time a venture-backed private tech company was valued at over $1 billion. We have over 200 today worldwide, and over half of those are in the US. And so you've got this glut of fabulous companies, high-quality companies that in prior years would have been public, would have been available to transact through these funds, and today are sitting on the doorstep with ranges from the Ubers and Airbnbs and Pinterests in the tens of billions range through to dozens of high-quality enterprise cloud companies that are sitting at the doorstep. And so many people are predicting that the doors could blow wide open in 2018. I don't quite see the trend swinging back entirely in that direction, but I absolutely think that a large number of companies are going to drop in their Q4 financials to hit the market in that late Q1 window to start the roadshows in March and early April if the market holds and timing lines up.
From your point of view, what are some of the factors that would blow the doors open?
Stability. We don't need outperformance. We don't need fantastic market multiples. We just need predictability. So low volatility and willing buy-side investors that are supporting the macro tech trends.
Does that include predictability on the regulatory front, including immigration like we've been talking about, including the tax code?
So for specific sectors, the regulatory environment has massive impacts, healthcare being one of them. A lot of companies want to get through that risk phase. But for the most part, I think those are forward factors. Tax policy and repatriation of international funds are a successful problem that these companies will face far into the future. Many of our companies that go public from the private tech world don't have the luxury of earnings and profits. They have the little brackets around their earnings statements. And so they're not optimizing for taxes quite yet.
Sure. What are some of the industries where specific industries where you think you'll see both new companies and new technology moving the needle next year?
Technology is ripping through all industries. We talked about the impact to healthcare, which is the world's #1 segment by GDP. So let's go on to #2, which is transportation. Automotive, a few years from now, will be completely transformed by the 3 big trends: electrification, on-demand, and soon autonomy. I don't believe kids born today in the US will get their driver's licenses. And it will seem like a hobby to drive a car, much like riding a horse is, because it's irrational and unsafe.
Yes.
The 30,000 plus deaths a year that are due to human error when driving a car can and should go away. Convenience, city landscapes will change. The autonomous wave will transform our modern cities, certainly. And that will start happening as soon as next year. The first autonomous vehicles will be available. The regulatory environment won't fully catch up to them yet, but that will roll through the next couple of years. And then you go down the list, construction. You now absolutely see workers on job sites with their iPads out, editing live plans, sending confirmations back and forth. You go to plumbing, HVAC, and electrical. The technicians show up at your doorstep, deployed through a mobile app. They're able to give you an estimate. They're able to call back for parts, and they're able to complete a transaction on site, all digitally. These things are rolling through all sectors of the economy. And what we like to say is that the hardware is getting softer and the software is getting harder, and that technology is finding its way into physical products in every walk of life.
If you look at the earnings statements and the outlook statements from, say, Ford and General Motors, the kinds of technology, including absorbing that autonomous driving world, would have been unthinkable even 5 years ago, I think. Do the legacy automakers have, open question to everybody, do you think the legacy automakers can keep up with this? I mean, they're certainly deploying resources in that direction. Anybody want to take that bait?
They cannot keep up. They're going to play because they can be late followers, but the leaders are clearly going to be companies like Tesla, Google. We'll see if Apple still is playing in the automotive, you know. But I think it's going to be led by them. And the important part, I mean, the car may say GM on it, but if they have to license the automated driving technique from somebody else, if they have to, purchase better electronics from an outsourced, I mean, the value in the car might increasingly go to, the technology leaders.
Yeah.
I would just add, there's over a dozen automotive companies spending over $1 billion towards the combination of this autonomy and electrification wave. And so I give GM some credit for they've been acquisitive, but also have invested internally. Certainly Google, Waymo, Apple, Tesla is a leader. You go down the list, Uber's got over $1 billion targeted to the autonomous efforts. You go internationally, a number of the German manufacturers are putting real efforts here and trying to close the gap. Certainly the Asian manufacturers, as well as a number of the pure play tech companies that are starting to launch their own autonomous initiatives, recognizing that the number 2 slice of the global economy is a big jump ball and a big prize if you can get it right.
Yes. Thank you. That's great. I would like to change the subject if that's okay with you all. I want to talk, let's talk for a second about inflation. Looks like for the first time in several years, it's on people's minds again. You've had the Federal Reserve signaling that it's going to continue to tighten interest rates, and you've had some wage growth that signals that it might bump the needle up a little bit. Kira, as someone who's very yield-oriented, what's your take on inflation? How is that affecting your strategy?
Sure. If we think about what's happening in terms of interest rates rising in the U.S., we do believe it's a reflection of an improvement in the economy. That's certainly a good thing, even for a strategy that is yield-oriented.
Sure.
Growth is good. So you need to focus on the companies that actually are growing and can offset the pressures that technically a rise in interest rates have on all financial assets in terms of the discount rate being applied. So by focusing on companies that are growing and can benefit from the improvement in the economy, you can certainly offset some of the pressures from rising interest rates. Interest rates are rising. We've been talking about this for 5 years now, and when they're going to rise, it actually feels a little bit of a relief to actually be in the environment where interest rates are rising. But even if you look at the sectors that everyone's going to assume, sectors like utilities are going to be challenged. Utilities have performed in line or better than the S&P since the first interest rate hike in 2015 here in the U.S. So as long as you're focusing on the right utilities, not just high-yielding companies, companies that actually have the cash flows and the growth to support their cash returns back to shareholders, we think that the rising interest rate environment, as long as it remains a reflection of an improvement in the economy, it's actually a good thing.
Is some of the change in energy policy under a new administration changing the landscape for some utilities or changing their growth prospects?
It does. You have to be from our perspective, when you invest in utilities, you have to be very cognizant of the regulatory environment that you're investing in, either the states in the U.S. or the countries outside the U.S. And you want to see that those allowed rates of return actually are reflective of some of the improvements that you're going to see in terms of renewable energy, improvements in the technology. I mean, even the utility sector is benefiting from technology, whether it be smart meters, not having to employ as many people to go out when there's a storm. You don't have to drive around the block to figure out where the tree fell to knock the power line. The smart meter can tell you this immediately. So as long as you continue to focus on good, strong regulatory environments where their incentive, part of the allowed rate of return is the incentive to reinvest in the network and continue to build the network going forward, it is a good thing.
Savita, what's your take on the inflation outlook?
Yeah, so inflation has been kind of fairly benign for quite a while, which feels uneasy because the Fed has been printing a lot of money, and normally you see inflation alongside that, and we haven't. One interesting trend that we're noticing in the U.S. is this growing scarcity of labor within more manual labor-oriented jobs. So, for example, our industrials analysts, our transports analysts have been writing about the fact that these companies, home builders, can't find manual labor types of workers. And the reasons are pretty unusual. So today, I mean, the reasons number from the opioid crisis. There are a larger percentage of people addicted to opioids, and that's shrunk the labor pool, or the pool of available workers. There's a higher incarceration rate. And we've also noticed that that the average, typically male member of society that signs up for these jobs are playing more video games. So there's 3 reasons for this paucity of labor that are really unusual, but it is actually showing up in margins. So you're seeing home builders having to pay higher and higher wages to court these workers back from other activities, I suppose.
And these are workers who are presumably not highly educated, but they do have a skill set that fits the job.
Exactly. So it's more on the manual side rather than the skilled labor side. But it is a trend that's just starting to percolate, and you are starting to see margins in those industries under some pressure. And I think that's something to watch going forward.
Are some of those industries able to pass those costs on to consumers at this
point,
or is it too soon? So that's the million-dollar
question, is whether they will have pricing power, whether the economy gets good enough, that gets strong enough that consumers are willing to pay the higher prices that offset the cost increase.
Speaking of not paying higher prices, I have been dying to talk about the Amazon effect. I cover a lot of retail and edit a lot of retail coverage for Fortune, and every story that I'm involved with at all is somehow a company or an industry defining itself in relationship to Amazon. And David, I know you have some thoughts about this,
Sure.
And would love to hear them.
Sure, Matt. I mean, I think it's much more broad than the Amazon effect, really. I mean, I've been doing this for 19 years. I've just never seen more disruption in more sectors than I do today. I mean, it is clearly Amazon and the impact that they're having on retail and legacy tech. But it's broader than that. We've already talked a little bit about autonomous cars, what impact that could have on GM, Ford, actually long-term sort of the railroad industry, if you will.
Sure.
Or think about shale oil. Shale oil is a sort of new phenomenon really in the last 10 years. That's really disrupting OPEC and the energy majors, if you will. And we talk about blockchain from a technology perspective, disrupting sort of money transfer or potentially title insurers down the road. It's just almost every sector out there is going through some change. And those sectors that are not, I'd say sort of like industrials, life sciences, actually maybe utilities are actually on the right side of secular change. My guess is over time, those companies' valuations tend to go higher than they have been historically because of the lack of secular risk. Hopefully Amazon's not getting into aircraft engines.
That's the
There's
million-dollar
definitely been
question.
a trend in the market to companies in the consumer space that are Amazon-proof or at least seem less subject to risk. A great example actually is the video game companies. I mean, are they tech or are they consumer? I would say they're both. But Amazon, there's a franchise there in making video games. That's not a skill set that Amazon has. Live Nation, a company that we know, live entertainment. They and Ticketmaster. They also own the venues. So music festivals is where most musicians make more money on live shows. And if you think about it, it's these are experiences that people value, and they're not Amazonable, right? So we have a kind of a theme within our bottoms-up strategy of looking for and considering the kind of risks of the Amazon effect, which is pretty vast. I mean, Whole Foods is the most dramatic example, right? They've moved directly into one of the most brick-and-mortar businesses that there is, and they are catalyzing, I think, a big change in our oldest industry, pretty much, right? Food retailing.
Supermarkets, yep.
And at the same time, giving themselves potentially a distributional advantage by having more, points of distribution for their own delivery service.
This
Kira,
is where the individual companies are going to have to distinguish themselves. So whether it be the suppliers, like take a Campbell's Soup, for example, you had a disruption of club stores, the Costco's and the Sam's of the world. You couldn't just take 6 cans of soup and add some plastic around it and sell it for cheaper. That was obviously would hurt your margins. So companies like Campbell's have to sit down and figure out, how do we operate within this new environment? How do we offer different packaging, different price points to make sure not only can we help the retailers survive, but also figure out how to get direct to consumers? Not saying necessarily Campbell's is going to be the winner here,
Sure.
but it's an example of a company that they really have to figure out how do you partner with this new influence from technology and the Amazons of the world, the Walmarts who have done quite well today. Also, just implement or be able to continue their strategies going forward. There's certainly going to be winners and there's going to be losers in this, and it's figuring out which companies have the right strategy, can adapt to the changes the best.
Does that sometimes mean increasing selection? I bring this up because you mentioned Campbell's. My colleague Beth Coet, who covers the food industry for Fortune, has written a lot about how big old food companies are investing in kind of little organic startups,
Yes.
and to sort of serve this a higher end market and a kind of a niche consumer that might pay a premium. Are you seeing that as a trend, not just in food, but elsewhere?
It is certainly a trend within food. Certainly the growth of the millennial space in terms of wanting cleaner labels in terms of what they're eating, simpler products. The idea the middle of that supermarket is a no-way zone. You want to only be shopping the perimeter where it's fresh, it's healthier, it's got a purpose, there's protein in it. So there is a lot of adaptation that has to go on. So it's not just the changing retail landscape that these food retailers or food suppliers are facing. It's also the changing consumer and the consumer shopping differently. It's all intertwined, but there's certainly a lot of pressure on these companies to adapt and adapt quickly.
Let's talk about energy for a second. I want to flip back to something that David mentioned about the shale oil revolution. Recent news from Venezuela, from Saudi Arabia, I feel like these are the kinds of events that 5 or 6 years ago would have sent oil prices through the roof. They've actually been relatively stable, and shale oil seems to have a lot to do with that. Looking at the year ahead, is oil in, say, the $55 to $65 a barrel range? Do you think that's at least the short-term new normal?
Actually, I would argue that oil will be lower in a year than it is today. I think in 5 years it'll be dramatically lower than it is today. And again, to your point, what's really changed about shale oil is, like, in the past, if you wanted to bring on new production, it was like a 3-year cycle. Today we have basically just-in-time production almost on shale. That you can put you can drill a new hole and actually have oil producing in 3 months, and you can see huge supply responses there. And it's really, again, disintermediating OPEC, essentially. OPEC is sort of losing share on a structural basis to the low-cost shale players. But it's actually even broader than that today. Now, as the majors have sort of been disrupted by that, they're responding by lowering their cost to be able to bring on new production offshore at $40, $50, where they used to need $70, $80 to get good returns. And that is really disruptive to OPEC, and I think it's really disruptive to oil prices. And again, we also talk about autonomous vehicles and electric vehicles. Long term, the demand side of the equation for energy is also a sort of a negative from my perspective. So you have more supply at lower costs, as well as declining demand over a long time. I think if you are a long-term investor, I think it makes a lot of sense to be underweight energy for the next 5 and 10 years.
There's also, the nat gas side for some reason seems to often not be discussed, which is actually, very equally important. Nat gas is very low. It's also a byproduct of the shale revolution in the U.S. Powers most of our electricity, right? And that, combined with renewables, I think, is another important trend that will affect energy prices globally. And then the final thing, actually, I guess I would add is, like, the autonomous driving Uber and Uber-like service, on-demand driving, transportation. I mean, these are efficiency-enhancing uses of technology. Small increases in efficiency in, miles per gallon, utilization of the car fleet on demand can have fairly large impacts in the oil markets in particular. So we also sort of have a negative long-term view.
Byron, is energy efficiency a big play in the venture space right now?
Energy opportunities are, and there's a big move certainly around the electric vehicle space, which we commented on, and enabling technologies for that.
Sure.
Battery technology, there continues to be heavy investment, as well as green tech in general. We've pulled back after significant losses in industry and solar. The international game, and with China in particular, was painful there.
Sure.
But the size of the market is too large to ignore, and with a number of these macro trends, there's a lot of innovation happening there.
Sure.
Solar is still growing rapidly, though. I mean, like all boom busts, there are, the early ones are usually winners, right? But the the capital that chases too much capital chasing too few opportunities, the solar industry, right? It did drop the cost of producing a solar panel to the point where solar is pretty much especially if you're not considering transmission and distribution costs. So when you get electricity, half of your cost as a retailer is really transmission and distribution. The other half is the generation. On a generation basis, solar is competitive with natural gas and coal.
Yeah, just not domestically produced.
Right, but there's one disintermediate. I mean, I'm curious what Kira would think, but there are large, single buyers for solar projects, right? They're sort of the middle market, not the utility scale and not the guy on the home, but say Walmart on a warehouse that can be a dedicated solar purchaser, no T&D needed. They're just generating locally and using locally.
Server farms, a lot of them are using solar?
Solar server farms can. Usually they're using it more for the cooling than they are for the servers. But another example of a dedicated kind of middle market user where they can get rid of the T&D costs and the generation locally is competitive.
Sure. I think we have reached the point in the conversation where I get to ask that concluding question, the biggest risk and the biggest opportunity. Do folks feel ready for that? Terrific. If you don't mind, I'll start with you, Byron. For 2018, where do you see the greatest risk and the greatest opportunity?
So for 2018, I think the biggest risk is geopolitical, both with tax and immigration policy, which we talked about, as well as international political stability. But I think the fundamentals of the economy and the businesses within the economy are quite strong and are likely to remain strong. And it comes down to, do regulatory or geopolitical things change the environment in which they operate to dramatically change the business characteristics. On the opportunity side, we've talked a lot about how tech is the largest sector of economic growth. Software within tech is the biggest driver, and cloud computing is the future of software. And so as a firm, we have disproportionately bet on cloud computing, and I think 2018 is very much a double down year where that trend is going to accelerate even more.
Absolutely. Thank you. Savita, what's your thinking? What's the greatest opportunity and greatest risk for 2018?
Sure. So I'll start with the risks. And I actually think there are two big risks in 2018. And one is just, how we move from a 40-year period where we got really used to a very low cost of capital, a falling cost of capital, where leverage was essentially free and cash yielded nothing. And I think that moving from that scenario to an environment where the Fed is tightening, where quantitative easing is generally shifting to quantitative tightening, I think that's going to be a little bit tricky, especially if you look at valuations of some of the most bond-like stocks in the S&P. Like utilities, I think, is too expensive given what we might see over the next 12 to 24 months. So that's there are areas of the market that typically do well in a downturn, like regulated utilities, that might not do as well in a downturn if that downturn is caused by a rate spike. So I think that's what could be different this time that the market is not necessarily prepared for. I think the opportunities are manifold. The way I see this year, and we've touched on this, is that it could be a great year for sifting through the winners and the losers. So thinking about the Amazonification of the different marketplaces, I think within the consumer discretionary sector, the internet and catalog retailers might win, and some of the bombed out retailers might remain bombed out and even go lower. So I think that there is an opportunity right now to really look for winners and losers within sectors rather than just buying the market wholesale and betting on a beta trade.
Thank you. Dan, what do you think?
So I'll start with the risks too. On a geopolitical scale, I would agree. A risk of a geopolitical conflict is definitely concerning to me. On a market basis, I'm a little worried about the massive amount of money that's flowed into index, ETF, and quantitative-oriented strategies and sort of a computer-driven flash crash. It wouldn't necessarily be something that is very long-lasting, but could be sharp and kind of scary and pull into question a lot of what's going on with. There are more ETFs now than there are stocks. And companies are actually their biggest buyers of their own stocks because of their strong cash flow. So there's been a real imbalance in supply and demand around in the market, and I worry about that effect in terms of sort of what will all that quantitatively driven money do if it sort of tends to be herd-like. But most specifically, I mean, we're definitely most optimistic about tech, software, cloud computing, software as a service. We definitely agree those are very strong trends. Companies generally are sort of digital business transformation, adapting to the digital world. They have the money. It's been several years since the crisis. labor is scarce. Talented tech employees are very expensive, and so it's exactly the right time when companies invest in these things to improve their efficiency and also to bring themselves into the next wave of business. But we also do like a lot of the internet media and advertising trends that are happening around companies, like whether it's video gaming or e-commerce. And we think Amazon's effect is interesting because I think there's a lot of companies that will be hurt by Amazon, but a lot are going to be benefiting because they're going to be playing into the Amazon economy.
Sure, sure.
What we're most concerned about within the marketplace, I think, is actually low growth companies without a lot of pricing power. Stronger dollar effects would be pernicious for them. And then also just sort of maybe not well placed with, in particular, millennials. We haven't talked about that, but the millennial consumer. So I think a lot there of actually the consumer staple names that are beloved historic companies, but they're just not the brands or the products that the millennials are interested in. And it also extends into apparel as well.
They're not your daughter's fashion brand. Right. Kira, what's what you're thinking? Greatest risk, greatest opportunity?
I would echo a lot of what I've heard about geopolitical risks. I think any policy errors by central bankers. So I'm not actually concerned that interest rates are going to spike or rise too quickly, but were that to happen, I think that wouldn't just be detrimental to the more defensive sectors, it would be detrimental to everybody. Well, I think it's more about, will the growth remain? Can companies maintain their capital allocation policies? Will companies continue to return cash to shareholders via dividends, share buybacks, and debt reductions from our perspective? But really, it's a risk of a geopolitical risk or policy error that would cause people to have to change their capital allocation policies. I think the opportunities, we like to say tech is the new macro. While if you're looking at dividend stocks, it's hard to find direct investments within the tech space. However, the influence on that technology has across all sectors in terms of the revenue growth, the profitability. It means margins can stay at higher levels. It means cash flows can remain higher, and there's a lot more cash to continue to be returned back to shareholders. So I think there's a real opportunity to look for the individual companies that are profitable today and will continue to be profitable going forward and can withstand any potential pressures that the market might feel.
Thank you. David, last word. Greatest risk and greatest opportunity.
Sure. Let me start with the greatest opportunity. I think tax reform would be the greatest opportunity, just from an earnings perspective. I think with the last 5 years in the market, we've basically grown earnings on a compound rate about 5% per year for the last 5 years. If you actually had tax reform in 2018, you could see earnings growth is more like 13 to 15% potentially, depending on what the corporate rate does. I think that would be a positive for the market, sort of an acceleration in earnings growth. In terms of negatives, and I know this is a sort of a one-year outlook, a 2018 outlook.
Sure.
But what I would say is, today, I don't invest on a one-year horizon. I invest on a 3 to 5 year horizon. And I think if you have a 3 to 5 year horizon, you're starting from a point where valuations are high, and I think we're not early in the cycle, we're probably later in the cycle today. That's not a good combination. So what I would tell investors today is, next 3 to 5 years, you should expect equity returns below what long-term averages, and the odds of a big drawdown, again, given where we are in the cycle and given how high valuations are, is probably greater than average. Does that mean 18 is going to be a down year? I have no idea. But I think next 3 to 4 years, I would assume that lower returns with greater risk.
Thank you, David, and thank you all so much. It's been great to have you on the panel. Again, this is the Fortune 2018 Investor Roundtable, and thanks for watching.